Hi, this is Brodrick for Uncommon Wisdom Daily. Today I want to share 3 charts with you that I believe are great snapshots of the global demand for commodities. First up is a look at China's iron ore inventories, which measure the stockpiles currently at the various ports in China. You can see that while off their highs, those stockpiles are trending higher. Now for the bad news. This chart is a little behind the times. The port of Qingdao, through which 1/7 of all iron imports to China pass, has actually run out of space to take in more goods. What's more, a senior China steel executive recently told reporters that most of the steel mills are only maintaining a minimum level of production. In other words, the slowdown in China may be worse than many people think. The next chart shows the total Eurozone composite PMIs, which combine manufacturing and services. That's the blue line. It fell to 45.1 in April, and all 4 of the largest Eurozone nations are now reporting sharp downturns in their manufacturing sectors. This is a strong indication that Europe is headed into another recession. Policymakers there are dropping interest rates, as you can see, but not fast enough to deal with the economic downturn. I really don't know how European leaders can talk their way out of this one, and maybe there will be decisive action on this grand bargain that we keep hearing about, but considering their track record, it's not likely. Why is this important to commodity prices? Well, Europe is one of the world's biggest economies. If it's going into recession, demand for commodities of all types will be reduced. Now for chart number 3, which shows global crude oil supply versus demand. As you can see, demand is not rising as fast as expected, while supply is rising beyond expectations, with new production from North America's shale oil deposits and countries like Iraq and Libya. The result has been a sharp decline in crude prices. Brent crude sunk to $97 a barrel, and West Texas Intermediate recently hit $83. The U.S. is now sitting on more oil supply than it has since 1990. That's good news for American consumers, since gasoline prices tend to follow the price of oil. But it's bad news for investors speculating on higher prices. So, to sum up, China's demand for industrial metals seems to be under pressure. Europe's economies seem to be sliding into recession. And there is plenty of oil in the world to meet demand, at least for now. This tells me that industrial commodities like oil, iron ore, aluminum, copper, and more will probably see lower prices ahead. If you're investing in the sector, you might want to hedge your bets with bearish funds that go up as prices go down. I'm Brodrick for Uncommon Wisdom Daily. Thanks for watching.